Hello, everyone, and welcome back to the J22 Report. I am your host, Johnnie Market. You all know that drill. Hit that like button and subscribe if you already haven't. And I just wanted to say, trying to grow my channel, and a lot of channels have a service to sell you right now. What I'm asking for costs you nothing, zero, as you can see. Just hit the like button and subscribe. And before we get into my weekend, I'm going to do another one, hopefully tonight. I haven't been doing them as much during the week, just very busy. So hopefully I'll get one tonight. I've divided this into two. And just do a disclaimer, nothing I talk about should be construed as investment advice. Just, my opinions on and thoughts on the markets. Just remember I'm not a financial advisor. So anyway, let's just get into today's couple of things I noticed, wanted to share with you all. First thing I looked up is there's something by Citi here. Citi gold settles at all-time highs. This was, 4 or 5 days ago. Citi sees potential for continued gains to 3,000. Now, in this upswing, that is my target, 2,700 to 3,000. So you heard it from me first. But let's see, Tuesday trading, Federal Reserve officials ramped up expectations of U.S. rate cut in September, which I think they're going to do. The economy is looking poor, and here it is, looking bullish on growing expectations as the Fed will begin cutting interest rates in September, which were confirmed by commentary from Jerome Powell on Monday, which kept U.S. Treasury yields low and maintained positive outlooks for non-interest bearing bullion. So let's see. Fed Powman indicating interest that the Fed was going to grow, more confident that inflation was back on its way to the target. But if you look at this is one thing, thanks to largely to weakness in economic data and falling inflationary pressures. Bond yields continue to remain under pressure, which is helping boost the appeal of low to zero yielding assets. So the weakening U.S. labor market, broader trend of disinflation, notably soft CPI, strengthens argument for a dovish policy by the Fed. So Citi emphasized inflows into bullion ETFs. So anyway, this is what it said. And, if you've been following this channel, we talked about how the economic data was getting worse. And it will continue to get worse. So you can hear Citi, they see gold for 3,000. They say sees the potential. So that way they're not wrong. They're trying to hide. You look at it, they're going to say, see, we were right. We called for 3,000. But no, we just said potential. So that way they're right. And, they're not wrong. So what a wimpy way thing. So anyway, that's the first thing. Let's go to evictions. And see, this is the thing. The bifurcation economy is just what happens before the crash. Evictions rising across Southwest, dropping in Northeast. Well, yeah, they go in the Southwest, but they're going to go everywhere. And so Las Vegas, Houston, and Phoenix saw increases in evictions. Philly and New York reported drops. Well, yeah, they have evictions surge as rents increase, housing is less affordable. Of course, the ones that don't really have a surge have renter protection. So it's not like those areas, incomes are rising, jobs are plentiful. It's just so let's go on this. Eviction filings increased by 35% or more in 6 larger cities compared to pre-COVID trends. Half of the cities with the largest surge found in the Sun Belt, Las Vegas, Houston, and Phoenix. So you can see. So yeah, this is just the nuts and bolts of it. But look at this, signing off on eviction file after hearing the tenant failed to make rent just twice. So see, people are not being able to make rent. Despite the jump in evictions across Southwest, general trend seems to be nearing 2020 levels once again. Well, yeah, it just jumped in the Southwest. These companies start to lose money, and but yeah, here's the kicker. They always hide stuff. Some places like New York City, Philadelphia, Wilmington, Delaware recorded massive drops in evictions, likely due to new renter protection policy. So they'll tell you evictions aren't surging there, but it's not because incomes. It's due to renter protection policies. And if these policies weren't in place, evictions would be surging everywhere. But what's going to happen is the fact that they can't evict. Eventually, what they're going to do is they're going to start getting rid of it, causing selling, mass selling. And that's what people forget. So, though slight, the downward trend is shifting eviction nationwide back to previous levels. So evictions increase alongside rent, asking prices for rentals jumped in the aftermath of the pandemic. So yeah, here it is. Cost burden because they spend more than 30% of their income on housing and utilities. So the recent unprecedented increase in homelessness in communities across the country are a result of those equally unprecedented and unjustified rent hikes a couple of years ago. So yeah, if you look at this, a recent report found that buying a home in USA is less affordable than any other time in the last 17 years, only emphasizing the pressure many home buyers may already have been feeling. So as you can see, evictions are starting to surge, and they're eventually going to spread. And the only reason they're not in a lot of areas is because of renter protection. So you can see this is why the economic data, as you go in the last article, is becoming weak. This type of stuff is starting to show up, and it's going to spread more. One other thing I wanted to say is I don't think this is a sign of a top, but I would love to know what he knows. Nvidia CEO sells another $30.6 million in shares, and of course they say it's part of an option plan. And of course, they always make sure small block, 30.6 million. Of course, they do all this. So basically, Microsoft and Apple are the only companies. Nvidia used to be the largest company. So yeah, that's the thing is, why is they selling? This follows, I don't know how to sell his name, selling 30.7 million shares from July 5th through July 8th. 169 million during the last week of June. So as you can see, this selling is more than just a one-time event. He is continually doing this. So I would love to know what he knows. Maybe he just thinks the stock is top. So, and this is the other thing that sort of supports and go this one. The economy is becoming very weak. Domino's Pizza slides after quarter two. Sales fall short of expectations. And it's not just Domino's, it's Papa John's. These are regular pizza places people of all incomes sort of get. It's a Friday night, you get delivery. Domino's Pizza fell sharply early trading on Thursday after the pizza chain operator missed revenue estimates. So there you go. Uh, let's see. But obviously they have increase in supply chain revenues, but offset by a shift in relative mix of products sold. So total domestic store comparable sales growth was not what expected. So yeah, this one was just sort of more but if you look at it, US companies store gross margins decrease. So gross margins, which is generally revenue minus cost of goods sold, doesn't count a lot of overhead. The decrease is primarily higher insurance cost, increased labor costs as a result of higher wage rates. This decrease was also partially offset by sales leverage due to higher customer transaction count. Supply chain gross margin increased 4 percentage points in the quarter, primarily due to procurement productivity, partially offset by investments in supply chain labor. So, as you can see, Domino's, Pizza, and even Papa John's, they're falling short of expectations. It seemed profitable still, but as you can tell, it's still not doing great. There are problems. It's starting to show up in the data. They're starting to show up in the earnings reports. And yeah, as you can see, problems in the economy are starting to persist. So anyway, that's all I have. I'm going to try to do another one tonight. Hit that like button and subscribe if you already have it. And I will see you next video.